Hello there, this is James and you're watching Tixee Live. And a very good afternoon to all of you, and all of you a very happy Wednesday. In today's program, I want to talk about another central bank intervening into the market and the impact on what it actually means, on what that intervention actually is and how that's impacted the market, and some other developments as well, in particular for Apple as well, which is also a bit of a worrying sign. But before we get into all of that, don't forget these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence, and of course know the risks at hand before entering any trade. With that out of the way, let's get started. So we have been anticipating this for a while, ever since obviously Monday's incredibly dramatic decline in the sterling and the complete meltdown of the UK financial markets. And the Bank of England has indeed taken action, but not the way we thought they would. There was much anticipation of them calling an emergency meeting and doing an emergency interest rate hike to obviously try and give the sterling some strength, but they haven't done that. Instead, they've intervened into the bond market. The bond market was under horrendous pressure. There's no doubt about it. And this was causing an incredibly unstable market, the bond market. And so the bond market in general, like I said a couple of days ago, are going through a very torrid time. But the UK bond market were trading at levels or interest yields not seen since, say, 2010, which was very worrying for the market. So what the Bank of England has done to try and stabilize the bond market, and I'll explain a little bit what it means and what the implications are. Basically, they said they will start buying 20-plus-year bonds starting today till October. And this is basically what's known as emergency QE. QE stands for quantitative easing. Quantitative easing is when a central bank buys government bonds or corporate bonds. They do this to try and stabilize the market and create income for things like pension funds to use. And I'll explain to you how it works. Because when they buy bonds, okay, it increases that bond value and results in the bond yield decreasing. Now, don't forget, the UK bond market was set to have the sharpest monthly rise since 1957. So by this action by the Bank of England has calmed the bond market down, and the stock market in general a little bit. It's given it a little bit of calm for the time being. So this is what they've done, and the way it generates additional income is that, say for example, they buy a bond for £1 million, for example. That bond, that £1 million can then go towards a pension fund, which can then go into other investments for that pension fund. So this is good for the pension funds and good for the bond market, etc. It's not so good for the sterling, though, which we'll have a quick look at. But just so you know, that they've had an instant impact with this interaction. This, of course, is intervention. In fact, the 30-year bond yield is now trading at 3.95%. Earlier today, before their action, it was trading at 5.12%. Remember, the higher the bond yield, not so good. The lower the bond yield, good news. So that has been the impact. And like I say, it's not been good for the sterling in particular. We'll bring the sterling up now, actually, and have a quick look at it, and then we'll have a look at the rest of the market as well. So this is the sterling. This is on a 30-minute chart. Now, obviously, when BOE announced they were going to do this action, Okay, this is the candle here. You can see the sterling spiked up higher because it was indeed a form of intervention done by a central bank. But then after a while, when they realized it was mainly for the bond market and it wasn't going to be, this could possibly be it, they ain't going to do an emergency interest rate hike. It then fell under pressure and it traded under a sort of key level of 1.06939. It has since then found a little bit of a boost and currently trading at 1.0726, but still not terribly encouraging for the sterling. To be fair, it's still finding under pressure because we still got a very strong US dollar. If we look at the euro sterling as well, similar picture. Initial reaction, euro weakened, but then as I realized it was mainly for the bond market and to stabilize the bond market. It's not the sort of intervention the market was hoping for the sterling. Again, as you can see, the euro gained a little bit more strength, actually went above 90. It's now back under 90 just and currently trading at 0.8974. So, yeah, I mean, but I tell you something, it's not been amazing news because I think obviously the currency market or currency traders, the FX market is expecting something a bit more. And the big concern is, I think, for sterling bulls is is this all they're going to get from the BOE? Because obviously the sterling is under horrendous pressure. It is trading very near the all-time lows as well. So, and the dollar is still very, very strong. And that is half the problem. We'll talk a little bit about that in a moment. So, the market's looking at this. Okay, is this it? This is what the Bank of England is going to do? Are they going to wait till November? Like they keep saying, and raise interest rates. Can they wait that long to raise interest rates to save the sterling? And the other thing about the bond, yes, bond market is good for corporation bonds and corporations and for the pension market. It's not good for mortgages, obviously, as well. So that's the other thing. So, like I said, this is why I think this intervention is something at least it's calmed the bond market down for now. And it has, like I say, given the market in general a teeny bit of a boost because it brought down US bond yields have come down because of this as well. So let's have a quick look at the market in general as well. Let's look at the S&P 500. As you can see, okay, because of Bank of England's intervention, again, the market in general, the stock market in general, has got a bit of a boost because it is bringing down bond yields across the board, not just the UK bond yields, but US bond yields as well. And we can currently see the S&P 500 is currently trading at 3,681 points. So it has had a little bit of a boost. If you look at on a daily, is today going to be the day where it's finally going to, close the session with gains? Because look how many days it's had as losses. 1, 2, 3, 4, 5, 6 days of losses. Is this going to be the day to finally break that run? Because don't forget, that's the longest losing streak the S&P has had, like I said this morning, since February 2020. So could this be the slight turning point for today, not for the long run, but for today only, for the S&P to close slightly higher? The NASDAQ as well, again, slightly better as well, 11,351 points. But guess which one has really benefited the most from, in many ways, from the Bank of England? Hands up. Anyone want to make a guess what's benefited the most at the moment from it? And that is, of course, gold. Look at gold. And the gold was under extreme pressure at the beginning of the session. But now it's severely bounced back. It's currently trading at 1,651. Again, this yellow metal is benefiting from the Bank of England's intervention. Reason being, because it's brought down UK yields, it's brought down US yields. What was hurting the gold the most? Two things. Strong US dollar. We still have a pretty strong US dollar, so that's not changed. But US bond yields was hurting it badly. So the fact that the bond yields have dropped slightly now because of the BOE and what they've done is benefiting gold a lot. Currently trading at 1,650. But you've still got that key level of $1,667 to really break before we can really see any sort of bullish momentum on that as well. So that's it. The one main big benefactor is gold. Because like I say, today it's trading very low, but it's managed to have a good, nice little bounce back because of what the Bank of England has done. Right, there's something else I really want to talk about as well. Still on the subject of central banks intervening. Obviously, we've got Jay Powell is speaking at the moment. I call him Kapow. That's my nickname for him. He's speaking, and obviously he's been extremely hawkish. I'm not expecting him to put any comments about his outlook. I think he will stop on that. But this is the question I want to start. I want us to have an open debate about, and that is okay. Obviously, the sterling decline was triggered by the mini budget, obviously, but there's other problems before that. Obviously, economic slowdown, Bank of England being pretty tepid with interest rates because they're trying to balance their economy. But the other thing is we've got a very, 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 very strong US dollar. A very strong US dollar, which is really breaking things. It's really damaging the global market, okay? Because the euro is suffering because of it. Obviously, other factors as well, but the strong US dollar is a major, major thing. It's hurting the euro, the Chinese yuan, the sterling, okay? Because we have a strong the yen being another one. Don't forget the yen has had to intervene. And the question I have to ask is this going to be the beginning of a central bank war? Because back in 1985, we were facing something very similar. A very strong US dollar. And it's during Reagan's year, Reagan economics, they called it. A very strong US dollar, which was punishing all the other currencies and the other economies. And if you think about it now, we've had 2021 was a year of stimulus by the US Fed, okay, pumping the government with steroids. And now they've done very aggressive interest rate hikes to fight inflation, which is moving interest rates higher to around about 3% over in the States. So this has implications because a stronger dollar has implications across the world. Back in 95, my original point, when we had a strong dollar, the central banks got together and it came to an arrangement to weaken the dollar to help the sterling, the euro, no, it wasn't the euro back then, the Deutsche Mark and things of this nature. Okay, they help weaken the dollar, they help these other economies which were under pressure because of the strong dollar. Okay, so whether we will get something like that, because now you've had two central banks have had to intervene to try and calm the market. The Bank of Japan to try and stop the dollar yen rot, or the yen rot, shall I say, and fight back against the dollar. And now the Bank of England to try and calm the bond market down. And like I say, it's not all because of the dollar, but the strong dollar is beginning to break things. So I'm just wondering, are we going to get to that point that the central banks can get together and start realizing they're going to have to work together on this? Because obviously the situation in the US is very different to the situation in Europe and the situation in the UK and the situation in Asia. So are they going to actually coordinate and work together in solving what potentially could be a really, really big issue for the whole globe financially? But so that's something I'll be interested to talk about. And obviously I'm sure open to people's opinions and views on that, of course. On another story, Apple, not so smart. Their demand for their new Apple phone, iPhone 14, much anticipated iPhone 14, has disappointed. There's not been a surge in demand for this new smartphone as they had hoped. In fact, they've actually asked their suppliers not to increase production. So they're happy to keep the current production levels they've got. They were going to ask for an increased production of about 6 million. They've said, no, don't do that for now because the demand is in there. And what's a little bit worrying about that is obviously the smartphone market is a good gauge of the retail market in many ways. Or how much loose income people have, because, we're spending our money on expensive items like the latest iPhone 14, then obviously it's quite a liquid market. We have spare money in our pocket. And excuse me, sorry. And the fact that Apple has said their demand for their new phone, their new flagship phone, is disappointing, and they're stopping suppliers to increase production, is a bit of a worrying sign for the future, potentially, especially as we're expecting, we've got the earnings season coming up in October, which would be interesting to see. So could this be a sign of things to come, which is something to consider. Apple has actually, in fact, the share price pre-market fell around 4% on this recent announcement. Let's have a quick look at Apple now, see where Apple is currently. Now, as you can see, look, it did open with a gap. It closed around $151.45, but it opened at 145, so it did drop quite dramatically. But okay, it's trying to bounce back now. But like I say, the share price is still under pressure because that demand is disappointing. And I'm just wondering if this is is this a sign of things to come in the future? You know, are we going to see more companies sort of disappointed with sales? And like I say, we're building up. Don't forget, we're building up to earnings season. It starts in October, and we're only 2 days away from that. So it'll be interesting to see. Anyway, other major events happening this week as well. Don't forget, we've got German CPI tomorrow. Expectation 9.4%. US GDP, which I will be doing a watch along tomorrow. UK GDP. Oh, that's going to be interesting. And obviously EU CPI. The market as it currently stands, like I say, the Bank of England's given it a teeny-weeny boost. FTSE in the green is 0.10%. DAX currently trading slightly negative, 0.24%. Euro Stoxx 50, slightly better than this morning, though. Negative still, but negative 0.10%. Don't forget, you can ask me questions anytime you wish, or simply say hello if you like. I mean, what do you think? Do you think the central banks are going to get together? Because I say, obviously, the US dollar is breaking everybody else's stuff, so to speak. You know, it's breaking everybody else's stuff, you know, and the Fed has been incredibly aggressive, and obviously all the other central banks are trying to catch up, but they haven't got the toolbox the Fed has to do as much as they can. So that there is something, whether or not they can coordinate with helping this current issue. Time will tell. Time will tell. Yeah, but share with me your opinion. What do you think? And what do you think about Apple? You know, are you going to go and buy the new Apple 14? You know, and like I say, is this an indication of bad times or worse times to come? You know, if the demand for the latest flagship smartphone from one of the biggest companies in the world is beginning to wane, what does that say for everything else? But anyway, okay, if there is no questions, don't forget, if you think of a question later, you can put it in the comment section, either on Facebook and YouTube. I will see them, and I will reply to them next time I go live on air. But anyway, until next time, don't forget, I'll be online again tomorrow at 8:30 a.m. UTC, then again at 12:30 p.m. UTC to do the watch along of the US GDP, and then again at 5 p.m. UTC to do the US session and all the latest developments. So please come and join me for that. Anyway, as I always say, if you're watching me on Facebook and you enjoyed this little video, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little video, subscribe if you like. Hit the notification button so you know next time when we're going live. If you enjoyed this video and you put up with me, my over-the-top enthusiasm for the markets, then simply give me one of these. It's nice to know that you like what I do. Anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.